Let me ask you something. If you had 3 buckets of money, would you know which one to dip into first in retirement? Most people don't, and that's okay, because today we're going to break down the 3 types of retirement income in a way that actually makes sense. First up, taxable income. This is the money that gets taxed every single year. Think savings accounts, brokerage accounts, mutual funds, stocks, and bonds. You earn interest or dividends? Uncle Sam wants his cut every single year. It's like planting a garden and paying taxes on every tomato you pick. Next, tax deferred. This is your 401k, your traditional IRA, your annuities. You don't pay taxes while it grows, but you will when you take it out. Here's the metaphor. Would you rather pay tax on the seed or the harvest? With tax deferred, you're betting that future you will be in a lower tax bracket. But what if you're not? And finally, tax-free. This is the unicorn bucket. Roth IRAs, Roth 401ks, municipal bonds, and some types of life insurance. You pay taxes up front, but then boom, no taxes on the back end. Tax-free income is like having a golden goose that lays untaxed eggs, but you've got to plan ahead to get it. So which bucket should you use first? That depends on your goals, your tax bracket, and your timeline. But here's the real secret. It's not about picking one, it's about balancing all 3. A smart strategy called tax mapping can help you figure out how much to keep in each bucket to stretch your retirement dollars further. Want to see how your buckets stack up? Join us at an ARI workshop near you. We'll walk you through it step by step. And hey, if this helped you, give it a thumbs up, subscribe for more, and share it with someone who's staring down retirement with a lot of questions and not enough answers.